Hi dear, welcome to your favorite audiobook channel Wisdom Flicks. How to day trade for a living, a pro trader's daily routine and risk strategy. Introduction. Welcome to the trading floor. Welcome to a world where every second matters, where decisions are made in milliseconds and fortunes can shift with the flicker of a candlestick chart. Welcome to the trading floor, not just the noisy pits of Wall Street, but the desk in your home office, the coffee shop booth with Wi-Fi, or anywhere your laptop and trading platform come to life. This is where discipline, knowledge, and strategy meet opportunity. Day trading isn't just a job. For many, it's a calling, a lifestyle, a thrilling yet demanding pursuit of financial independence. And unlike the 9-to-5 grind, it offers the freedom to control your time, your income, and your direction. But here's the truth. Freedom comes with responsibility. This book isn't about get-rich-quick illusions or risky gambling disguised as trading. This is about how professionals do it, with structure, with process, and with purpose. That if you're here, you're probably intrigued by the idea of trading for a living. Maybe you've dabbled in stocks or crypto, or perhaps you're starting completely fresh. Either way, you've already taken the most important step. You're curious and you're hungry to learn. That's what separates those who dabble from those who dominate. Let me tell you what this book is and what it's not. This is not a crash course in stock market slang or a long list of confusing indicators. It's not a glorified diary of wins and losses, and it's definitely not going to sell you dreams without giving you the tools to chase them responsibly. Instead, this is a professional blueprint, a detailed, practical, and experience-backed guide designed to show you exactly what it takes to day trade for a living. From waking up in the morning and prepping for the market open, to placing high-probability trades with discipline, to closing your day with purpose and reflection, you'll learn the habits, tools, and strategies of full-time traders that you'll get insights on. Building your daily routine like a professional trader, risk management systems that protect your capital, choosing the right markets and platforms, structuring your trades with logic, not emotion, journaling, review, and continuous improvement. And perhaps most importantly, how to develop the mindset to survive and thrive in this game. This book draws from the lived experience of real traders, their mistakes, their victories, and their lessons. Every chapter is designed to be both educational and actionable, whether you're trading stocks, options, futures, or Forex. And it's written in a tone that's easy to absorb, even if you're listening while jogging, commuting, or sipping coffee. Let me be honest, day trading isn't easy. You'll face setbacks. You'll doubt yourself. But if you can develop the discipline, emotional control, and structured approach of a professional, you'll be miles ahead of most retail traders. Because the truth is, your edge isn't a secret indicator or a magical chart pattern. Your real edge is you, your preparation, your mindset, your ability to adapt. And that's exactly what we're going to sharpen in this book. So, whether you dream of walking away from a day job, building a second stream of income, or simply mastering the art of strategic decision-making, know this: you're in the right place. You're doing the right thing. Take a deep breath. Step onto the virtual trading floor. And let's begin. Chapter 1. What is day trading? Let's start with the basics. Day trading. What exactly is it? At its core, day trading is the act of buying and selling a financial instrument within the same trading day. That means you open a position and close it, all within the same day. No overnight holds. No waiting days or weeks for your profits to grow. Just pure, focused, intraday action. Whether it's stocks, options, futures, Forex, or even cryptocurrencies, day trading applies to any market where price action moves swiftly and opportunities can appear and disappear in a matter of minutes. Unlike long-term investors, day traders aren't concerned about the company's annual growth report or next quarter's earnings. Instead, they care about what's happening right now, this hour, this minute, this second. They trade based on short-term patterns, volume, spikes, price momentum, and volatility. It's fast, it's intense, and when done correctly, it can be incredibly rewarding. The core principle of day trading: day traders thrive on one fundamental principle: small, consistent profits over time. They're not swinging for the fences every day. They're not risking it all on one trade. Instead, they aim to make a series of calculated moves, each based on probabilities and a proven system. Imagine a professional poker player, not gambling wildly, but patiently waiting for the right hands, folding often and capitalizing when. The odds are stacked in their favor. That's what a skilled day trader does. They wait. They plan. They execute. And they exit, sometimes with gains, sometimes with small losses, but always in control. How it differs from other trading styles. To better understand day trading, let's briefly compare it to other styles of market participation. Investing. Investors hold positions for months or years. Their goal is long-term growth, often through value investing or dividend reinvestment. They care about a company's fundamentals, future potential, and macroeconomic trends. Swing trading. Swing traders hold positions for a few days to a few weeks. They capitalize on short to medium-term trends, but don't typically enter and exit trades in the same day. Scalping. Scalpers are the ultra-fast, micro-movement traders. They open and close positions in seconds or minutes, making dozens, sometimes hundreds, of trades a day. Day trading can include scalping, but it typically involves slightly longer holding periods. Day trading sits between swing trading and scalping. It's rapid, but not always frantic. Strategic, yet highly time-sensitive. The psychology behind day trading. Here's something most beginners don't realize. Day trading is as much a mental game as it is a technical one. Sure, charts, indicators, and data matter, but your mindset? That's your true weapon. You need focus. You need emotional discipline. You need the ability to take a loss and move on, without revenge trading, without panic, because the market doesn't care how you feel. It doesn't reward effort. It rewards execution. Many people are drawn to day trading for the excitement. And yes, it can be exhilarating. But over time, you'll learn that consistency beats excitement. Professionals aren't addicted to adrenaline. They're obsessed with precision. What do day traders trade? Now let's talk about the instruments. Day traders don't limit themselves to one kind of asset. Here are a few popular markets. Stocks, highly liquid, especially large-cap stocks like Apple, Tesla, and Microsoft. Traders love earnings announcements. And news catalysts. Options, great for leveraged exposure with defined risk, though complex and volatile. Futures, often used to trade indices like the S&P 500, commodities, or currencies. They're leveraged and run nearly 24 hours a day. Forex, foreign exchange, the world's most liquid market, trading currency pairs like euro to US dollar or pound sterling to Japanese yen. Cryptocurrencies, a newer playground for day traders, with wild volatility and 24/7 market access. Each market has its own rules, rhythms, and risks. Later in the book, we'll help you find which one fits your lifestyle and personality best. What makes someone a professional day trader? A common misconception is that professional day traders work on Wall Street or in big institutions. Not anymore. Thanks to powerful trading platforms, fast internet, and global broker access, you can be a professional trader from your bedroom, as long as you treat it like a real business. Here's what separates a professional from an amateur. They have a trading plan and follow it. They manage risk first, profits second. They track performance through journaling and analysis. They never let emotions drive decisions. They know when not to trade. Being professional is a mindset, not a certification. Why day trading appeals to so many? There's something uniquely empowering about day trading that you're not dependent on a boss. You don't have to ask for a raise. You control your schedule, your income, your growth. If you do it right, day trading can become a high-performance career, a game of mental mastery and strategic decision-making. You don't need a PhD. You don't need a degree in finance. What you need is the right education, the right system, and the right habits. And that's exactly what this book is here to give you. Key takeaways. Let's recap the essentials. Day trading is the practice of buying and selling within the same day, focused on short-term price movements. It's different from long-term investing and swing trading due to its speed and precision. Success in day trading isn't luck, it's structure, risk control, and emotional discipline. Anyone can become a day trader with the right mindset, tools, and training. It's not about chasing money. It's about building a repeatable process that works over time. Chapter 2. Who can become a day trader? When people think of day traders, they often imagine a high-powered Wall Street broker in a suit, surrounded by monitors, making lightning-fast decisions in a skyscraper office. But the truth is, you don't need a finance degree. You don't need to live in New York. And you definitely don't need to wear a suit. Day trading has evolved. Today, some of the most successful traders are regular people, working from home, trading from their laptops, in pajamas or gym clothes, sipping coffee as the markets open. The better question isn't, can I become a day trader? The better question is, am I willing to become the type of person who can thrive in this field? Let's explore that. Day trading is not about who you are. It's about who you're willing to become. Here's the great news. Anyone can. Learn to day trade. Whether you're a student, an employee, an entrepreneur, or someone between jobs, if you can commit to learning, practicing, and developing a professional mindset, you have what it takes. You don't need to be a math genius. You don't need to predict the future. You don't need a six-figure account. What you do need is the willingness to study, the discipline to follow a plan, and the patience to grow step by step. If you can approach trading like a skill-based profession, not a game or a gamble, you're already ahead of most beginners. Traits of successful day traders. So, what kind of person thrives in this world? What traits do successful day traders often share? Let's look at a few. 1. Disciplined day trading rewards structure, not spontaneity. The best traders follow routines, stick to their strategies, and avoid emotional decisions, even when things get tough. Point 2. Emotional control. Markets are unpredictable. Prices spike and crash. Trades go against you. If you panic, chase losses, or let fear take over, you're playing a losing game. Calmness under pressure is a superpower. Point 3. Curiosity. Good traders are constantly learning. They study the market, their trades, their psychology. They treat trading like a craft because it is. Point 4. Patience. Ironically, successful day traders don't trade all day. They wait for the best setups, even if it means sitting idle for hours. Patience creates profits. Point 5. Adaptability. Markets evolve. What works today might not work tomorrow. The best traders evolve with the market. They test, adjust, and stay sharp. Point 6. Resilience. Losses are part of the game. No trader wins 100% of the time. If you can take a hit, learn from it, and get back in the game smarter, you're on the path to mastery. What background do you need? Here's something empowering. You don't need a financial background to succeed in trading. Some of the best traders come from fields like engineering, teaching, real estate, or even the arts. Why? Because it's not about what you studied, it's about how you think. Yes, understanding basic math and percentages helps. Yes, familiarity with charts and platforms speeds up the process. But more than anything, what matters is, can you follow a system? Can you learn from mistakes? Can you stay calm when it counts? If you answered yes, even cautiously, you're more ready than you think. Is day trading right for your lifestyle? Now let's talk practicality. Before diving in, ask yourself, does day trading fit the life you want to build? Day trading requires time and focus, especially in the early stages. You'll need to commit a few hours a day to learning, watching the market, journaling, and refining your craft. Here's what you should consider. Are you available during key market hours? In most regions, that's between 9:30 a.m. and 11:30 a.m. local time, when volume and opportunity peak. Can you create a distraction-free environment? You'll need focus. Even 2 hours of full concentration is better than 8 hours of half attention. Are you financially stable enough to learn without pressure? You should never trade with money you can't afford to lose. Start small. Learn first. Do you have the patience to build slow and steady? Many fail because they expect instant results. Day trading is a marathon, not a sprint. That if your lifestyle allows for focused time, mental clarity, and a bit of startup capital, you're in a great place to begin. How much money do you need to start? Here's a common misconception. You need thousands of dollars to start trading. Reality check. You can start learning with a demo account. $0, full experience. You can start live trading with a small account. $500 to $2,000 is often enough to begin with micro positions. However, you should never start with your rent money, emergency fund, or borrowed cash. Trading is about staying in the game long enough to learn how to win, and that requires protecting your capital like gold. Day trading is not for everyone, and that's okay. Let's be real. Day trading is not a guaranteed path to riches. It's not a fit for everyone, and that's completely okay. That it's not for those looking for fast money without effort. It's not for people who can't handle stress or uncertainty. It's not for those who resist structure or despise rules. But if you value freedom, personal growth, and strategic thinking, If you're drawn to challenges and you're willing to treat trading like a business, not a bet, then day trading can become one of the most fulfilling journeys of your life. Real talk. Your trading identity. Every great trader eventually discovers their own style, their own rhythm, preferences, and rules. But that only happens through consistent effort and self-awareness. Maybe you're a cautious strategist. Maybe you're a pattern-spotting chart wizard. Maybe you love speed, or maybe you prefer precision. The beauty of trading is you get to define your edge. And that journey, it starts by becoming the kind of person who is willing to learn, adapt, and grow. Key takeaways. Let's wrap this chapter with a few truths. Anyone can learn to day trade with the right mindset, education, and discipline. You don't need a specific background. What matters most is your mental approach. Successful traders are emotionally disciplined, adaptable, and always learning. Day trading requires time, attention, and responsible capital management. It's not easy, but it is possible, and it can be worth every ounce of effort. Chapter 3. The Trader's Mindset. What if I told you that your biggest trading weapon isn't a technical indicator, a secret strategy, or even market knowledge? It's something far more powerful and much harder to master. It's your mindset. Ask any seasoned trader and they'll tell you, trading is 20% strategy and 80% psychology. Yes, you need a solid plan. Yes, you need to understand charts. But when the market moves against you or in your favor, your ability to stay grounded, logical, and emotionally neutral will make or break your career. This chapter is your mental training ground. We're going deep into the psychological side of trading, the habits, beliefs, and inner battles that shape every successful trader. Let's dive in. Why mindset matters more than strategy. You can have the best strategy in the world, one that's back-tested, optimized, and proven profitable. But if your mindset is weak, that strategy won't save you. Here's why. You'll abandon it after 2 losses in a row. You'll chase a bad trade out of frustration. You'll overtrade after 1 good win. You'll freeze when you should act. You'll trade with fear instead of confidence. The market is a mirror. It reflects what's going on inside of you. And if your mind is chaotic, undisciplined, or driven by ego, your trading results will show it. That's why mindset isn't optional. It's essential. The battle between emotion and logic. Let's talk about the internal war that happens every day on the trading floor. Emotion versus logic. Logic tells you to follow your plan. Emotion tells you to double down on a bad trade. Logic tells you to take profits according to your rules. Emotion whispers, just a little more, don't close yet. Logic warns you to cut your losses. Emotion begs you to wait, hoping it will turn around. Sound familiar? The most dangerous trader is not the uneducated one. It's the one who knows what to do but can't control themselves enough to do it. Winning in this business means choosing logic every time, even when your emotions scream the opposite. Emotional discipline, the professional's edge. So how do the pros stay calm when the market goes wild? They've trained themselves. They don't just have a strategy, they have a mental framework. They've built the emotional muscle to act consistently, regardless of market conditions. Here are a few emotional traps to watch for and how to fight them. 1. Fear. Fear causes hesitation, missed entries, and early exits. It shrinks your vision and magnifies threats. Solution? Preparation. When you trust your plan and position size responsibly, fear loses its grip. Point 2. Greed. Greed says, just one more trade, just a little more. It leads to overtrading, revenge trades, and abandoning your system. Solution? Define your profit targets before you enter the trade and stick to them. Let the market come to you. Point 3. FOMO, fear of missing out. You see a stock rocketing up. You jump in, too late, and lose money. Solution? Remind yourself, opportunities are endless. Chasing leads to regret. Trust your setups. Point 4. Overconfidence. One good week, and you think you've mastered the market. You increase your position size and blow your account. Solution? Stay humble. Stay consistent. Let your process, not your ego, lead the way. The foundation of a strong trader's mindset. Let's break down what makes a truly resilient trading mindset. 1. Self-awareness. Know your emotional triggers. Are you more likely to panic or get greedy? Awareness is the first step to control. 2. Detachment. You are not your trades. Wins don't make you a genius. Losses don't make you a failure. Stay emotionally neutral. 3. Process over outcome. Focus on the process, not the profit. Great traders care more about following their plan than about how much they made. 4. Discipline. Do what you said you'd do, even when it's boring or uncomfortable. That's real discipline. 5. Patience. Wait for your setup. Don't force a trade just because the market is open. The best trade is often the one you don't take. Your mindset must be built before you trade. Many new traders make a dangerous mistake. They jump into the live market with real money before building the right mindset. That's like stepping into a boxing ring after watching a few YouTube videos. You're not ready for the punches. Before trading live, practice in a demo account. Develop your rules. Experience losses without losing money. Journal your emotions. Simulate the pressure and learn how to stay composed. Mindset isn't learned in theory. It's forged in practice. A daily mental routine for traders to build and maintain a strong mindset. Try this daily mental routine. Morning, pre-market, review your plan. Visualize executing it with discipline. Remind yourself, your job is to trade your system, not your feelings. During trading brief, stay aware. Take breaks when needed. Repeat your affirmations. I follow my rules. I trade with clarity. I stay calm under pressure. After the market, journal your emotions and decisions. Celebrate discipline, not just profits. Reflect on how you felt, not just what you earned. This mental hygiene is what separates serious traders from impulsive ones. Rewiring your brain for consistency. Here's something fascinating. Your brain is rewired every time you make a decision. If you chase a trade and it works, you train your brain to be impulsive. If you skip your rules and make money, you weaken your discipline. If you follow your system, even through a loss, you build consistency. Consistency is a muscle. Every trade is a rep. So, trade like the trader you want to become. Key takeaways. Let's lock in the lessons from this chapter. Your mindset is more important than your strategy. Emotions are your biggest enemy. Learn to recognize and neutralize them. Great traders don't just have skill. They have discipline, self-control, and patience. A strong trader separates themselves from the outcome. They focus on the process. Build mental rituals. Train your brain to act consistently, not impulsively. Chapter 4. Understanding the markets you'll trade. Welcome to one of the most important decisions in your trading career. Choosing your market. Before you make your first trade, you need to ask yourself a powerful question. What am I trading? And why? Because day trading isn't a one-size-fits-all game. Some traders thrive in fast-paced, high-volatility environments. Others prefer slow, steady markets with cleaner trends. Some love stocks. Others swear by Forex. Some live and breathe crypto. The key isn't choosing the best market. It's choosing the right one for you. This chapter will walk you through the major markets available to day traders, highlight the pros and cons of each, and help you develop a clear understanding of where you want to play and how to win. What does it mean to understand the market? To understand a market, you need to grasp 3 core elements: its behavior, how it moves, when it's volatile, and what affects its price; its structure, how it's traded, what instruments are used, and what hours it operates; its psychology, who is trading it, why they're trading it, and what drives their decisions. Once you understand these things, you can trade with confidence, not guesswork. Let's explore the primary markets. 1. The stock market. This is where many beginner traders start, and for good reason. The stock market is liquid, regulated, and familiar. You're trading shares of companies like Apple, Tesla, or Microsoft. It's accessible and highly active during specific hours. Key features: open hours, 9:30 a.m. to 4 p.m. Eastern Standard Time. U.S. market. Volatility window. First 2 hours of market open equals highest movement. Market movers. News, earnings reports, economic data, social media buzz. Pros. Highly liquid stocks offer quick entries/exits, easy to find educational content and tools. Regulated environment with strong protections, excellent for pattern-based strategies. Cons. Pattern day trader, PDT. Rule: if your account is under $25,000, you're limited to 3-day trades in a 5-day period in the US. Subject to gap risks if holding overnight short selling can be harder with certain brokers. Ideal for traders who love patterns, price action, and news-based trading. If you want to trade during the day and be done by afternoon, stocks may be your game. 2. Forex market. Foreign exchange. The Forex market is the largest financial market in the world, with over $6 trillion traded daily. You're trading currency pairs like euro to US dollar, pound sterling to Japanese yen, or US dollar to Swiss franc. Key features: open hours, 24 hours, Monday through Friday major sessions. London, New York, and Tokyo are the most active market movers. Interest rates, central bank policy. Political news pros: open 24 hours a day, flexibility in trading schedule, high liquidity, and tight spreads on major pairs. Leverage options available with many brokers, no PDT rule. Cons: leverage cuts both ways. Risk of overtrading, lower volatility in certain sessions can be complex to interpret. Macroeconomic factors ideal for people with flexible schedules, those living outside US hours, or anyone interested in global finance. If you want to trade the world's money and enjoy economic analysis, Forex might be your field. 3. Cryptocurrency market. The rise of Bitcoin and Ethereum has opened the door to a completely digital, decentralized market. Crypto never sleeps. It's open 24/7. Key features: open hours, 24/7, including weekends. Major coins: Bitcoin, BTC, Ethereum, ETH, Solana, SOL, and more. Market movers: sentiment, blockchain upgrades, media hype. Regulations pros: extreme volatility equals major profit potential. Open all the time, day or night. It's live, decentralized, and accessible globally. Lower capital requirements to begin. Cons: volatility can be a double-edged sword. Unregulated exchanges may pose risks. Liquidity varies by coin. High emotional noise from social media ideal for risk-tolerant traders who love fast action and innovation. If you're comfortable with volatility and love staying on the cutting edge, crypto could be your playground. 4. Futures market. Futures are contracts that allow you to trade commodities, indices, and currencies based on future price expectations. Popular instruments include crude oil, CL, gold, GC, S&P 500 E-mini, ES, and more. Key features: open hours, almost 24/6, with short breaks. Market movers: economic reports, global demand, geopolitical events. Tightly controlled. Regulated with centralized exchanges, CME, NYMEX. Pros: no PDT rule. Excellent leverage with low margin requirements. High liquidity in major contracts, good for systematic strategies. Cons: leverage amplifies both profit and loss. Less beginner-friendly due to contract complexity. Overnight margin changes can trigger issues. Ideal for experienced or highly focused traders who prefer structure and precision. If you love technical analysis and want to trade macro themes, futures are powerful tools. Which market should you choose? Here's the honest truth: every market works. If you work it, there's no better market. There's only the one that fits your time. Availability matches your risk tolerance, aligns with your interests, feels intuitive to your trading style. If you're new, you might start with stocks or Forex. If you're tech savvy and adaptable, crypto might excite you. If you're methodical and analytical, futures may be your game. Try demo trading in each market for 1 to 2 weeks. Feel the flow, study the behavior, then choose where you feel most comfortable and consistent. Understanding volatility, liquidity, and volume. No matter which market you choose, you must understand 3 vital dynamics. Volatility: how much price moves in a given time. More volatility equals more opportunity, but also more risk. Liquidity: how easily you can buy or sell without slippage. More liquidity equals faster, cleaner executions. Volume: how many trades are happening. Higher volume often equals stronger and more reliable. Trends: aim to trade assets with high liquidity, good volatility, and strong volume. These give you better setups and safer entries. Pro tip: focus beats diversification at first. As a beginner, don't try to trade everything. Pick one market, maybe 1 or 2 assets, and master them. Learn their rhythms. Study their charts. Notice how they react to news. Once you've built consistency in one area, you can expand. But mastery comes from focus, not fragmentation. Key takeaways to wrap up this essential chapter: understand the behavior, structure, and psychology of your chosen market. Explore stocks, Forex, crypto, and futures to find what suits your goals. And personality: prioritize assets with high liquidity, healthy volatility, and solid volume. Demo trade each market before committing real capital in the beginning. Focus deeply on one area. Don't spread yourself too thin. Chapter 5. Tools of the Trade. Your trading setup. Welcome to your command center. You can have all the knowledge, all the strategy, and all the mindset, but without the right tools, trading becomes like navigating a storm with no compass. Think of your trading setup like a cockpit. Every piece of equipment has a role, and when everything works together, you operate with clarity, speed, and confidence. In this chapter, we're going to build that cockpit piece by piece. From your physical workspace to the digital tools professionals. Trust, you'll learn exactly what you need, and nothing you don't, to trade like a pro. Your trading environment. Creating the right space. Before we jump into software and screens, let's talk about your physical space. Because if your environment is chaotic, your decisions will be too. Keep it clean and minimal. Cluttered desk, cluttered mind. You want a space that promotes focus and reduces distractions. Remove unnecessary items from your workspace. Keep a notepad, pen, and water nearby. Make it feel professional. This is your business. Comfort matters. You'll spend hours at this desk, so make it ergonomic. Use a comfortable, adjustable chair. Consider a standing desk option. Keep your screen at eye level to reduce strain. Lighting and noise. Soft, natural light is best. Avoid glare on screens. Use noise-canceling headphones or Playcom background. Music. Keep your space quiet and separate from distractions. No phone, no TV. Your mindset is built in your environment. Make yours reflect clarity and control. Hardware essentials. What you actually need. You don't need a $5,000 trading computer to succeed, but you do need reliable and fast hardware that won't freeze when the market moves fast. Your computer speed and RAM. Aim for at least 8 GB RAM, though 16 GB is better. Processor. Intel i5 or higher. AMD Ryzen 5 or higher. SSD, solid-state drive, faster boot time, and smoother software use. Monitors. Most professional traders use at least 2 monitors. This allows you to monitor charts on one screen, manage orders or news feeds on the other. More screens equals better multitasking. But start with what you can manage. Computer. Mouse accessories. A reliable mouse and keyboard, wired for faster response. Backup power supply, UPS, to prevent outages. Stable and fast internet. Wired Ethernet is preferred over Wi-Fi. Trading is a game of milliseconds. Your hardware must keep up. Software and platforms. Your digital toolbox. Now, let's explore your core digital tools. These are where trades happen, data is read, and decisions are made. Point 1. Broker platform. This is where you buy and sell. Choose a broker that offers fast execution, low spreads, and commissions. Real-time data, user-friendly interface. Popular choices: TD Ameritrade, Thinkorswim. Interactive brokers: NinjaTrader, TradeStation, MetaTrader. 4/5 for Forex, Binance, or Coinbase for crypto. Always check that the broker is regulated and offers strong customer support. Point 2. Charting software. This is your map. Charting platforms help you analyze price action, set indicators, and plan trades. Top platforms: TradingView, web-based, excellent for stocks/crypto/forex. Thinkorswim, powerful for US stocks/options. MetaTrader. 4 or 5, great for forex/commodities. NinjaTrader, excellent for futures. Look for a platform that allows customizable charts, supports indicators and drawing tools, offers replay/simulation features, works smoothly on your system. 3. News feed. Markets react to news instantly. Stay informed with Bloomberg, Reuters, Benzinga Pro. Forex Factory for Forex news. Twitter/X feeds for market analysts. You don't need to be a news addict, but knowing what's moving markets can protect and inform your trades. Trading Journal, your secret weapon. If you skip this tool, you're limiting your growth. A trading journal tracks every trade, every mistake, every win, and every emotion. It helps you see patterns you can't catch in real time. You can use a spreadsheet, Google Sheets, or Excel, Notion, or Evernote. Specialized tools like TraderSync or EdgeWonk track date and time entry/exit, trade size, why you took it, what went right/wrong. Emotional state journaling is where you turn experience into wisdom. Don't skip it. Optional tools for enhanced trading. As you grow, you might add tools like screeners, find trade setups with Finviz for stocks, Scanner, and Thinkorswim. TradingView filters crypto screener tools, alert system, set price alerts to notify you of trade setups using TradingView alerts mobile apps from your broker Telegram/Discord bots simulators practice in a no-risk environment using Thinkorswim's Paper Money. TradingView's bar replay MetaTrader demo account simulators help train your eye without draining your wallet. Risk management tools, these aren't optional, they're essential. Position size calculators know how much to risk per trade with tools like MIFSBOOK Calculator, Baby Pips Position Size, Tool Custom Excel/Google Sheets Stop Loss, and Take Profit Planning. Set these before you enter a trade. Automate them when possible. Your platform should allow predefined brackets for every order. Risk management is the difference between amateurs and professionals. What you don't need. Yet, many new traders get lost in tools they don't need. Avoid buying expensive third-party indicators or signal services, following random gurus with no proof, using 10 monitors when 2 would do. Constantly switching platforms. Focus on mastery, not excess. Start simple, grow smart, build your setup with these 3 pillars. Let's simplify. A good trading setup includes reliable hardware, fast computer, 1 to 2 monitors, strong internet, smart software, broker, charting platform, news feed, journal, stable environment, quiet, clutter-free. Focus space. This is your trading foundation. And a solid foundation means less stress, fewer mistakes, and better execution. Key takeaways. Your trading setup is your mission control. Build it for clarity, speed, and confidence. Invest in quality tools, but don't overcomplicate. Simplicity wins. Maintain a clean workspace and organized system for peak focus. Use journals, simulators, and alerts to build consistency. Never trade without a risk plan. Tools don't replace discipline. Chapter 6. Chart Reading Basics and Technical Indicators. Decoding the market's language. Welcome to the language of price, the universal dialogue spoken by traders across every corner of the world. It's not English or numbers, it's charts. When you learn to read charts, you're learning to listen to the market. You're not just guessing anymore. You're observing what buyers and sellers are doing in real time, and you're spotting opportunities before the crowd. In this chapter, we'll break down the basics of chart reading, types of charts, candlestick patterns, key technical indicators, how to build your own chart reading habit. Let's get started with the foundation. What is a price chart? A chart is simply a visual representation of price movement over time. It shows where price was, where price is, and potential clues for where it's going. It's like the heartbeat of the market. Learn to read it, and you'll know when to enter, when to exit, and when to sit tight. Types of charts. There are 3 main types of charts you'll see on most trading platforms. 1. Line chart plots the closing price over time. Simple, clean, but lacks detail. Good for long-term trend views. 2. Bar chart shows open, high, low, and close. OHLC gives more insight into volatility and price action. 3. Candlestick chart, most popular, also shows OHLC, but in a visually intuitive format, easier to spot patterns and reversals. Candlestick charts are the go-to for most day traders, so let's focus there. Understanding candlesticks. Each candlestick represents a chosen period of time: 1 minute, 5 minutes, 1 hour, etc. Each candle shows open, where price began; close, where price ended; high, the highest point reached; low, the lowest point reached. Green candle, bullish close is higher than open. Red candle, bearish close is lower than open. The body shows the range between open and close, while the wicks, or shadows, show the high and low. Think of each candle as a battle between buyers and sellers. When you string them together, you see the story unfold. Candlestick patterns. Every trader should know. You don't need to memorize 50 patterns. Start with these foundational few. 1. Doji open and close are almost the same signals. Indecision in the market. Watch for a breakout afterward. 2. Hammer small body with a long lower wick appears after a downtrend, suggests reversal upward. 3. Shooting star small body with a long upper wick appears after an uptrend, suggests reversal downward. 4. Engulfing patterns. Bullish engulfing. Big green candle covers previous red. 1. Bearish engulfing. Big red candle swallows previous green. Signals momentum shifting. Direction patterns are not magical. They're contextual clues. Combine them with volume, support/resistance, and trend direction for power. Support and resistance. Market memory. Support, a price level where buyers step in, price bounces up. Resistance, A level where sellers step in, price gets rejected, imagine. A ball bouncing between the floor, support, and ceiling, resistance. These zones often repeat because they reflect trader psychology and market memory. Mark these areas on your chart and observe how price reacts when it approaches them. Trends and trend lines. The trend is your friend until it bends. Every market is either uptrending, higher highs and higher lows downtrending, lower highs and lower lows ranging, moving sideways within a zone. Use trend lines to connect swing highs or lows. A valid trend line needs at least 2 touches and often acts as dynamic support/resistance. Mastering trend identification helps you align your trades with the market direction, a key principle of consistent trading. Must know technical indicators. Indicators are tools based on price and volume that help you make decisions. But remember, they're not crystal balls. They're confirmations, not commands. Let's go over the most valuable ones for day traders. 1. Moving averages, MA, show average price over a time period. Simple moving average, SMA, and exponential moving average, EMA, are most common use. 4. Identifying trend direction. Spotting dynamic support/resistance, entry/exit confirmation. Common settings: 9 EMA, 20 EMA, 50 SMA, 200 SMA2. Relative Strength Index, RSI, measures momentum. Is the market overbought or oversold? Scale, 0 to 100. Above 70 equals overbought, possible pullback. Below 30 equals oversold, possible bounce. Use 4. Reversal signals. Confirmation of breakouts or exhaustion. 3. MACD, moving average convergence divergence. Combines 2 moving averages to identify trend strength and momentum. Look for MACD line crossing signal line equals entry signal. Divergence between MACD and price equals potential reversal. Great for spotting changes in trend momentum. Point 4. Volume, the number of contracts/shares traded in a time period. Rising volume equals strong conviction. Falling volume equals weak momentum. Use volume spikes to confirm breakouts or detect fakeouts. Combining indicators wisely. Avoid indicator overload. You don't need 10 indicators on your screen. The best traders use 2 to 3 core tools and focus on price action, support/resistance, trend, and momentum. For example, use EMA to track trend, RSI to measure strength, volume to confirm entry. That's it. Simple, clean, effective. Build the habit of chart reading. Chart reading is a skill, and like any skill, it grows with practice. Here's how to build your visual edge. 1. Pick 2 to 3 instruments and watch them daily. 2. Mark support/resistance zones. 3. Draw trend lines and note chart patterns. 4. Use replay tools to test ideas. 5. Log your insights in your trading journal. The more charts you study, the better your instinct becomes. Eventually, you'll feel setups the way musicians feel rhythm. Key takeaways. Candlestick charts show you what buyers and sellers are doing in real time. Learn basic patterns and how to spot trends with confidence. Support and resistance are the market's memory. Use them. Use a few trusted indicators like EMA, RSI, and volume to guide your trades. Consistent chart study builds your edge. Repetition creates intuition. Chart reading is like learning to see the matrix. At first, it's confusing, but with time, the chaos reveals patterns, and patterns reveal opportunity. Chapter 7. Mastering your daily routine. Structure, consistency, and focus. The real edge in day trading. Imagine a fighter entering the ring without warming up, without a game plan, without discipline. What happens? They get knocked out fast. Trading is no different. That it's not just about how you trade. It's about how you prepare, how you think, and how you review. Your daily routine is your true edge. It's what separates the amateurs chasing excitement from the pros who treat this like a profession. In this chapter, we'll build the ideal trader's daily routine step by step. Morning, trading hours, and post-market review. Let's step into your new rhythm. Morning routine. Win before you trade. The first win of your trading day happens before the market opens. It begins the moment you wake up, with how you prepare your body, your mind, and your tools. 1. Wake up with intention. Roll out of bed 5 minutes before the bell. Your mental state matters. Pro traders wake up at least 1 to 2 hours before the market. Why? It grounds you, reduces stress, gives time for planning. A solid routine might include light exercise, or stretching 5 to 10 minutes of meditation or deep breathing. A healthy, energizing breakfast. Journaling your focus for the day. 2. Review the news and market movers. What's moving today? Are there earnings reports, Fed announcements, economic releases? Use trusted sources: CNBC, Bloomberg, Forex Factory. Market Watch your broker's news feed. Twitter/X for fast updates from reputable traders. Look for stock/Forex pairs with major gaps. News that could cause volatility. Global sentiment from overnight markets. Write down your top 2 to 3 watch list items for the day. 3. Pre-market chart prep. Now look at the charts. Mark support and resistance zones, pre-market highs/lows, key levels from the previous day. Decide what are your A-plus setups. What will you avoid? This is where a trading plan forms. Without a plan, you're flying blind. During market hours, focused execution. Once the market opens, the environment shifts. Now it's about focus, execution, and emotional control. 1. Stick to your plan. You made a plan. Follow it. Avoid the temptation to jump into random trades. Ask yourself, is this trade part of my plan? Does it meet my strategy criteria? What's the risk to reward? If the answer isn't a firm yes, don't touch it. 2. Be selective. You don't need 10 trades a day. In fact, most pros only take 1 to 3 high-quality trades per session. Wait for price to hit key levels, confirmation signals, volume to align. Trading isn't about action. It's about precision. 3. Manage emotions in real time. Emotions spike during live trading, especially when money is on the line. Use a simple habit. Before every trade, take 1 deep breath. This resets your brain, keeps you in control. If you feel frustrated, take a break. Revenge trading. Step away. Overconfident. Reduce size. The market rewards patience, not pressure. 4. Monitor and adjust. Watch how the market evolves. Are breakouts failing? Is volume dropping? Is volatility rising? Be flexible, but not impulsive. Adapt without abandoning your discipline. Midday reset, if needed. If you're trading through the full session, schedule a midday reset. Why? Fatigue builds, focus drops, emotions can sneak in. What to do? Step away from the screen, take a walk, stretch, or hydrate. Mentally check in. Remember, clear mind equals clear decisions. Post-market routine. Review and reflect. Your edge is not just built in the moment. It's built after hours through reflection. 1. Journal every trade immediately after the session. Record entry/exit point, size, and result. Why you took it. What you felt, what you learned. Tools to use: TraderSync, Notion, or Evernote. Good old Excel. This habit is non-negotiable. It turns every trade into experience and experience into mastery. 2. Screenshot setups. Capture charts of your best trades, your worst trade setups that got away. Label them. Review them weekly. Create a playbook of setups you want to repeat or avoid. 3. Rate your performance. Ask yourself, did I follow my plan? Did I manage risk? Was I emotionally stable? Rate your performance independently of profit. Even a losing day can be a perfect day if you traded your plan. 4. Shut it down. Don't obsess over missed trades or stare at after-hours charts. End the day with peace. Do something unrelated. Read, journal, spend time with family, workout. Meditate. This helps reset your brain and protect your emotional capital for tomorrow. Weekly and monthly reviews. Your daily routine is powerful, but reviewing your progress over time gives you the big picture. Every weekend, review your trading journal, your best/worst trades, your emotional trends, your profit/loss breakdown by strategy. Ask what's working, what's not, what needs to be cut or improved. Every month, refine your process. This is where true growth happens. Key takeaways: your daily routine builds your discipline and consistency. The foundation of success. Start with a powerful morning routine. Prep your mind, review news, and chart your plan during market hours. Stay focused, trade your plan, and manage emotions after the market. Reflect and journal every trade for continuous improvement in each day and week with review and renewal. Don't carry stress forward. Success in trading is not a single breakthrough moment. It's a daily rhythm, practiced with care, lived with intention, and improved over time. You're not just learning how to trade. You're becoming a professional trader, one routine at a time. Chapter 8. Risk management like a pro. The real secret to longevity in day trading. If there's one principle that separates pro traders from casual gamblers, it's this: They don't focus on how much they can make. They focus on how much they can lose. This is risk management. And in day trading, it's not just important, it's everything. You can have the best trading strategy in the world, but without solid risk control, you're one bad day away from blowing up your account. In this chapter, we'll cover why risk management is non-negotiable, how to calculate your risk per trade, the importance of position sizing using stop losses like a professional, managing risk in real time, building rules to protect your capital and mindset. Let's build your shield. Why risk management matters more than strategy. Picture this. Trader A wins 7 out of 10 trades, but has no risk management. One bad trade wipes out all the gains. Trader B wins only 4 out of 10, but manages risk precisely. They end the week profitable. Trader B wins in the long run, every time, because risk management keeps your losses small and predictable, protects your emotional capital, allows you to stay in the game long enough to see success, turns trading into a business, not a bet. Step 1. Decide how much to risk per trade. Professional traders don't think in absolute dollars. They think in percentages. The golden rule is risk only 1 to 2% of your total capital on any single trade. So, if your trading account is $10,000, 1% equals $100 max loss per trade, 2% equals $200 max loss per trade. This is your risk per trade, your seatbelt. Even a string of losing trades won't destroy you. If you're risking more than that, you're not trading, you're gambling. Step 2. Position sizing. The core of risk management. Once you know your risk per trade, the next step is to calculate how many shares or contracts to trade. Here's the formula. Position size equals risk per trade divided by entry price, stop loss price. Let's say you risk $100 on a trade. Entry is at $50, stop loss is at $1.48. That's a $2 risk per share. So $100 divided by $2 equals 50 shares. You buy 50 shares. Not more, not less. This is position sizing. It keeps every trade aligned with your risk tolerance, whether you're trading stocks, forex, crypto, or futures. Step 3. Stop losses. Your best friend in the market. Many new traders avoid using stop losses because they're afraid of being wrong. But pros know that stop losses are not about admitting defeat. They're about controlling damage. There are 3 types of stop losses. 1. Hard stop, a preset order that automatically exits your trade at a specific price. Best for beginners and busy traders. Eliminates emotion. 2. Soft stop, mental stop. You decide to manually exit if price hits a certain level. Requires discipline and fast decision-making. Can be dangerous if your emotions take over. 3. Time stop. You exit the trade after a certain time if it hasn't moved. Useful in slow markets or for scalpers. Your stop should be placed based on the chart, not your feelings. Ask, where is the invalidating level of this setup? If price goes there, is the trade idea still valid? If not, set your stop loss just below/above that area. Step 4. Risk-reward ratio. Only take smart trades. Here's another golden rule of professional trading. Only take trades with a risk-to-reward ratio of at least 1 to 2. This means if you risk $100, your target should be at least $200 profit. That way, you can be wrong more than half the time and still make money. Here's how it plays out. Trade 1. Lose $100. Trade 2. Lose $100. Trade 3. Win $200. Trade 4. Win $200. Trade 5. Win $200 net. Plus $400, even though you were wrong 2 times. The key is to cut losses fast and let winners run. Step 5. Daily loss limits. Protect yourself from yourself. We all have bad days, even the best traders. But what makes them great is their ability to stop when the market isn't in their favor. Create 2 safety rules. 1. Max loss per day, e.g., 3% of your account once hit. You stop trading for the day, no questions asked. 2. Max number of trades, e.g., 5 trades per day. Avoid overtrading or revenge trading. These rules protect you from emotional spirals and give you time to reset. Step 6. Risk management in real time. The market is dynamic, so your risk management must be alive, not static. Pro tips. Move your stop loss to break even once your trade is up 1 or scale out. Take partial profits at key levels to lock in gains. Trail your stop as the trade moves in your favor. Use smaller size on higher risk setups or when market is choppy. Risk management is not just about defense. It's a tool to optimize gains while staying protected. Risk management equals emotional management. Here's a truth every trader must accept. You will have losing trades, but you don't have to become a losing trader. The best risk management plans are simple, repeatable, and emotionally neutral. Once your risk is defined, you no longer fear the loss. You accept it, manage it, move on. This mindset allows you to trade with clarity, objectivity, and calm, the true foundation of consistency. Key risk management reminders: never risk more than 1 to 2% of your account on any trade. Use position sizing to keep your losses controlled. Always place your stop before you enter a trade. Aim for at least 1:2 risk-reward setups. Set daily loss limits and walk away when they're hit. Adjust risk in real time, but never remove it completely. Journaling your risk behavior helps sharpen discipline over time. Final words on risk: your lifeline, not a limitation. Some traders resist risk management because they think it holds them back. In truth, it sets them free. When you manage risk like a pro, you stay in the game long enough to learn. You avoid emotional crashes. You build confidence over time, and you position yourself to scale when the time is right. Remember, your capital is your trading business. Protect it like your life depends on it, because your trading life does. Chapter 9. Entry and exit strategies that work. Precision over prediction. Winning the game with smart execution in the fast-paced world of day trading. Timing is everything. You can read the charts. You can prepare your risk. But if your entries and exits are off, your whole strategy collapses. Think of your entry as your opening move in chess. Your exit? That's your checkmate. In this chapter, we'll uncover the entry and exit strategies that professional traders rely on daily. These aren't vague tips. They're repeatable frameworks you can plug into your trading style today that lets sharpen your entry, refine your exit, and lock in profits like a pro. The psychology behind entries and exits. Before we get tactical, here's the big truth. Most traders fail not because their strategy is bad, but because their timing is emotionally driven. They enter too early because of FOMO, exit too late, hoping for more, exit too early out of fear, chase price, abandon logic. The fix? Create rules you follow without emotion. Let's dive into strategies that give you that discipline. Entry strategies that actually work. A good entry has 3 core ingredients. Context: what is the overall setup? Confirmation: what signal tells me it's time? Control: how do I manage risk from here? Here are the most effective entry methods used by seasoned traders. 1. The breakout entry, ideal for momentum trades, trending markets. You watching a stock consolidate tightly under a key resistance level. Volume is drying up. The chart is coiled like a spring. Then, boom, price breaks through with rising volume. What to look for? A strong base or consolidation. Clear resistance level break with volume spike. Enter just above the breakout place. Stop below the base tip. Only trade clean breakouts with confirming volume. Weak breakouts often fake out. 2. The pullback entry, ideal for trend continuation trades. Calmer entry. The breakout already happened. Now price pulls back to retest old resistance. Now support. You wait for confirmation, then strike. What to look for? Trending stock, higher highs, higher lows. Pull back to a moving average or previous resistance. Bullish candle, e.g. hammer or engulfing. As confirmation, enter on the confirmation candle. Stop loss below the pullback low. This entry gives you lower risk with tighter stops. Great for patient traders. 3. The reversal entry, ideal for fading momentum, catching tops/bottoms. Advanced. You're watching a parabolic move. Price stretches too far, too fast. Then you spot a shift. What to look for? Extended move with high volume reversal pattern, double. Top, shooting star, bearish engulfing. Price fails to make a new high, enter short after confirmation, stop loss above recent high warning. Don't try to catch tops without strong evidence. Reversals can fake you out hard. Bonus, pre-market planning for entries before the bell rings. Map out levels you'll trade, types of entries you'll use, risk, reward for each setup. When price hits your zone, you're ready, not guessing. Exit strategies that lock in profits. Getting in is easy. Getting out at the right time is where real traders shine. Your exit is where your discipline meets your edge. Let's cover 3 types of exits. 1. Target-based exit, the cleanest exit. This is the most structured method. I risk $100 for a potential $200 profit. I'll exit when I hit that $200. If your risk-reward is 1:2 or better and your plan plays out, just take the win. You can use fixed price targets, Fibonacci levels, pre-market highs/lows, previous resistance zone. Simple, effective, emotion-free. 2. Scaled exit, lock in, let run. Professional traders often scale out of trades. Why? Because it locks in partial profit, reduces pressure, gives room for big wins. Example, take 50% off at 1R, risk, move stop to break even, let the rest ride. To 2R or 3R, this gives you best of both worlds, security and upside. 3. Trailing stop exit, ride the trend. If you want to ride a big winner, use a trailing stop. Options include dollar-based trail, move stop up by 50 cents each new high, ATR-based trail, adjust with market volatility, EMA trail. Use the 9 EMA or 20 EMA to ride the wave when price closes below your trailing stop. It's your signal to exit. Pro tip, never widen your stop. Let the market take you out. When to exit a losing trade, don't hesitate. Let's be honest, this is the hardest part, but this is the truth. If a trade violates your setup, your levels, or your plan, it's no longer valid. Exit, do not. Move your stop, just one more. Cent, wait for a miracle, average down a losing day, trade, cut the loss. Protect your capital, live to trade again. Journaling your entry and exit decisions every day after the market. Record your entry, what setup, what confirmation, record your exit. Reason for closing, profit/loss, screenshot charts with notes over time. You'll see which setups and exit styles work best for you. This turns trading from chaos into data-driven mastery. Golden rules of entries and exits have a reason for every entry. No random clicks. Confirm with volume, candlesticks, or indicators. Never enter without a clear stop and target. Let the market come to you. Don't chase. Exit when your plan tells you, never your emotions. Lock in partials on winners, but avoid overtrading. One great trade beats 10 mediocre ones. Final thoughts. Trade with confidence. Exit with clarity. You don't need to predict every move. You just need a system you trust, entries you wait for, and exits you execute without fear. Master your entries and exits, and you will trade with calm, not chaos. Grow your account with precision. Build the discipline that defines a professional trader. Chapter 10. Trade journaling and review. Your most powerful trading weapon isn't a chart. It's reflection. Let me ask you something. That if a pilot flies every day without ever checking what went right or wrong, how long would they stay in the air? Now, imagine a trader who executes trades daily but never reviews them. No logs, no insights, no improvement. That's not trading. That's just guesswork on repeat. Here's the reality. Your journal is your mirror. It shows you who you really are as a trader and who you can become. This chapter will guide you through why journaling is your edge, what to track, and how. How to do a powerful end-of-day review, how to spot patterns in your performance, and how to build your personal playbook from your own trading. Now let's elevate your process. Why journaling is the #1 habit of professional traders. Most new traders think the secret to success is finding the perfect setup, but pro traders know the truth. Success isn't found in the setup, it's found in self-awareness. Your journal shows you which strategies work and which don't, highlights emotional mistakes you keep repeating, builds the data to refine your edge, keeps you accountable, consistent, and professional. You can't fix what you don't measure. Your trading journal is your scoreboard. What should you log in a trade journal? You don't need a fancy app. A simple spreadsheet or notebook will do. The goal is clarity, not complexity. Here's what your journal should capture for every trade. 1. Date and time. When did you enter and exit? 2. Ticker and market. What did you trade? Stock, Forex, crypto. 3. Direction, long or short. 4. Entry price and exit price. Exact levels you got in and out. 5. Position size. How many shares/contracts? 6. Stop loss and target. Where was your stop? What was your profit target? 7. Result, P&L. How much did you win or lose? 8. Setup type, breakout, pullback, reversal, etc. 9. Reason for entry. What made this trade valid? What confirmation did you have? 10. Emotional state. Were you calm, anxious, overconfident? 11. Mistakes or successes. Did you follow your plan? Break any rules? Bonus, screenshot your trades after each trade. Take a screenshot of your chart. Mark your entry and exit. Highlight your stop and target. Add notes like entered too early or perfect setup, followed plan. This creates a visual memory bank. You'll spot patterns faster. Over time, your screenshots become a library of lessons. Daily review. Your end-of-day debrief. At the close of every trading day, ask yourself, 1. Did I follow my plan? If not, why? 2. What was my best trade? What made it work? 3. What was my worst trade? Could it have been avoided? 4. How did I feel throughout the session? Did I react emotionally or stay neutral? 5. What will I do differently tomorrow? Goal isn't to beat yourself up. It's to become your own coach. Weekly and monthly reviews. Big picture thinking equals long-term growth. At the end of each week/month. Review all trades, calculate your win rate, analyze risk-to-reward ratios, tally how many trades followed your plan, list recurring errors, highlight your top strategies by profit. This is where transformation happens. You stop trading randomly and start trading intentionally. Build your trading playbook. Now comes the fun part. Over time, your journal will reveal your strengths. From this, build your personal trading playbook, a PDF or document that outlines your top setups with screenshots, your entry and exit rules, your risk management model, your mental preparation checklist, your trade routine. This becomes your battle plan, your trading Bible. When markets change, emotions rise, or you hit a rough patch, you fall back on your proven system. Patterns to watch for in your journal. Look closely, and you'll start to see. Are you consistently entering too early? Are you over trading in the first hour? Do you win more on breakout setups versus reversals? Do you make more money on lower volume days? Are you losing trades mostly outside your plan? This is how traders evolve. That you're not guessing anymore. You're learning from your own data, your most personalized source of truth. Simple journaling tools to use. You can start with Google Sheets or Excel, Notion for structured plus visual logs. Trade journaling platforms like TraderSync, Edgewalk, or TradderView. But remember, consistency beats technology. It's not what you use, it's that you use it every day. Real traders reflection. Let me share a quote from a professional prop trader. I started journaling because I kept making the same dumb mistakes. I kept taking emotional trades, breaking my rules. Once I started reviewing my trades every week, the truth stared me in the face. Journaling saved my career. You don't need a guru. You need a mirror. That mirror? It's your journal. Key takeaways. Journaling turns your trades into lessons. Log every trade. Entry, exit, reason, emotion, results. Screenshot charts with notes. Review your trades daily, weekly, and monthly. Look for patterns. Then fix or amplify them. Build a personal playbook from your best trades. Make your journal a non-negotiable part of your process. Final thoughts. Make reflection your edge. Anyone can click buttons, but very few take the time to reflect, analyze, and improve. That's what separates the inconsistent trader from the rising professional. Your journal will become the most valuable asset you have, more than any chart or strategy. Start today. Build your story. Write your evolution as a trader, one entry at a time. Chapter 11. Common mistakes new traders make. Avoid the pitfalls. Trade like a pro from day one. Every trader begins with excitement, a vision of quick profits, and maybe even dreams of financial freedom. But what separates those who survive and thrive from those who burn out? It's not brilliance. It's not even strategy. It's the ability to avoid the common traps that trip up nearly every new trader. A smart trader learns from their mistakes. A wise trader learns from others' mistakes. In this chapter, you'll learn the most dangerous and most common errors that destroy beginner accounts, and how to avoid them with confidence, clarity, and discipline. Mistake number 1. Trading without a plan. Let's start with the big one. Too many new traders enter the market without a defined trading plan. No entry criteria, no exit rules, no risk management. That's not trading. That's gambling. That a trading plan should include what setups you'll trade, when to enter and exit, how much you'll risk per trade, your daily max loss or gain, pre-market and post-market routine. A solid plan turns chaos into structure. Without it, you're just reacting, and reaction leads to regret. Avoid this mistake. Before placing a trade, ask, does this follow my plan? If the answer is no, walk away. Mistake number 2. Risking too much. This is how accounts get wiped out. New traders often risk large chunks of capital on one trade, hoping to win big fast. But when the trade turns against them, as many will, the damage is hard to recover from. Golden rule of risk. Never risk more than 1 to 2% of your account on a single trade. It might seem small, but this is how professionals preserve capital and stay in the game long enough to win. Avoid this mistake. Use a calculator. Define your stop loss before you enter, and size your position accordingly. Mistake number 3. Overtrading. After a few wins, excitement kicks in. You start placing more trades, chasing every setup, every flicker of movement. This is called overtrading, and it drains accounts and mental capital. Remember, you don't get paid to trade. You get paid to wait for the right trade. Point 1. High-quality trade beats 10 random ones. Avoid this mistake. Set a trade limit, maybe 2 to 3 solid trades a day. If you hit that limit, stop. Mistake number 4. Revenge trading. Every trader experiences a bad loss, but what you do next matters most. Revenge trading is when you try to get it all back with a fast, emotional trade. It's fueled by anger, not analysis, and it often leads to even bigger losses. Revenge trading is ego at war with discipline. Avoid this mistake. After a big loss, walk away. Breathe, review, reset. Come back the next day with a clear head. Mistake number 5. Ignoring the bigger picture. New traders often get caught in minute-to-minute price movement, forgetting that context matters. For example, trading long right into a resistance zone, shorting without realizing the overall trend is up, entering without checking market news. Trading without context is like driving blindfolded on a highway. Avoid this mistake. Before each trade, ask, what's the overall market trend? What's the news? Where are key support/resistance levels? Zoom out before you zoom in. Mistake number 6. Relying solely on indicators. Indicators can be helpful, moving averages, RSI, MACD, but new traders often treat them like magic signals, buying when they cross, selling when they flip. But here's the truth. Indicators lag. Price action leads. Great traders use indicators as confirmation, not instruction. Avoid this mistake. Focus first on chart structure, candlestick patterns, and volume. Let indicators support, not decide. Mistake number 7. Not journaling trades. You Can't improve what you don't track. Many new traders skip journaling because it feels slow or unnecessary. But this one habit separates the amateurs from the professionals. Your journal shows why you took a trade, what went right or wrong, your emotional state patterns, and your performance. Avoid this mistake. Log every trade, even the ugly ones. Especially the ugly ones. That's where your biggest growth lives. Mistake number 8. Changing strategies constantly. 1 week it's scalping. The next it's swing trading. The week after that, options, crypto, futures. Many beginners switch strategies too often, never sticking with one long enough to master it. It leads to confusion, inconsistency, and burnout. Success comes from repetition, not novelty. Avoid this mistake. Choose one strategy. Focus on it for at least 30 to 60 days. Track results. Tweak slowly. Mastery takes time. Mistake number 9. Thinking trading is easy. Social media makes it look simple. Screenshots of gains. I made $500 before breakfast. What you don't see, the years of effort, blown accounts, and mental stress behind those wins. Trading is one of the hardest professions in the world. Treat it with respect. Avoid this mistake. Approach trading as a craft. Study, practice, review, and refine. Don't aim for easy money. Aim for mastery. Mistake number 10. Not knowing when to stop. Sometimes the best trade is no trade at all. When you're tired, emotional, distracted, or just off your game, step back. Forcing trades leads to mistakes. Even professionals take mental health breaks, skip bad trading days, and sit in cash. Avoid this mistake. Have daily max loss limits. Have emotional red flags. And most importantly, listen to them. Final checklist. Avoiding newbie pitfalls. Do I have a written trading plan? Am I risking 1 to 2% max per trade? Am I trading only high-quality setups? Do I walk away after a big loss? Am I logging every trade in my journal? Am I sticking with one strategy and mastering it? If you said yes to all, you're on your way to pro-level discipline. If not, no worries. Start today. The best traders are simply the most self-aware. Final thoughts. Learn fast, fail small, improve daily. Mistakes are part of trading. You'll make them. I'll make them. Every pro has made them, too. But what matters is how fast you learn, how small you keep your failures, and how dedicated you are to getting better each day. That be why avoiding these common pitfalls, you give yourself a real edge. Not one that comes from magic indicators or secret setups, but one that comes from professionalism, patience, and process. Chapter 12. Building a trading plan. You'll stick to designing the blueprint for consistent, confident trading. Welcome to one of the most important chapters of your trading journey. That you've learned the psychology, the tools, the charts, and the routines. Now, it's time to bring it all together into a structure. A personal trading plan that you can follow with clarity and confidence. Because here's the truth. Without a trading plan, you're not trading. You're just reacting. Your trading plan is your blueprint. It guides your decisions, protects your capital, and keeps you from emotional errors. In this chapter, we'll walk you through step by step what a professional trading plan includes, how to personalize it to fit your lifestyle and psychology, how to create your rules and risk parameters, and how to actually stick to your plan. Even when emotions rise, let's design your strategy for success. Why every trader needs a plan. Think of your trading plan like a pilot's flight checklist. Before takeoff, the pilot runs through structured steps, regardless of experience. Why? Because human error, stress, and emotion can cloud judgment. And in trading, one emotional decision can wipe out days or even weeks of progress. A trading plan keeps you focused, eliminates guesswork, helps you grow through consistency, removes emotional overreactions, and builds long-term discipline. So, what goes into it? Let's break it down. Your trading plan should include 1. Your trading style. Are you a scalper? A momentum trader? A trend follower? Define your approach. Example: I am a day trader who trades US large cap stocks using momentum breakout setups during the first 2 hours of the market. 2. Markets you trade stick to a focused universe. Examples: NASDAQ stocks above $1 million average daily volume, top 5 liquid crypto coins, euro to US dollar forex pair only, less is more. Specialization equals expertise. Point 3. Time frame and schedule: will you trade full-time or part-time? Which sessions? Pre-market? Regular hours? Evening? What's your average trade duration? This should match your lifestyle. Your plan must be sustainable, not stressful. Entry rules: define your setup. Clarity beats complexity. Every setup you trade must follow clear entry criteria. Include chart pattern, e.g., bull flag, double bottom; volume behavior, e.g., spike on breakout; confirmation, e.g., break above VWAP or resistance; technical indicator filter, optional; news catalyst, if applicable. Example entry rule: I enter a long trade when price breaks pre-market high with volume 2x average above VWAP and on confirmation of strong bullish candle close. Make it rule-based, not feeling-based. Exit rules: know when you're out there are 2 exits in every trade. One for profit, one for loss. Profit target: where you expect to take gains. Stop loss: where you cut the trade if it moves against you. Exit examples: stop loss 1.5%, below entry or key support level. Profit target 2-to-1 risk reward ratio, or at next resistance level. Trailing stop to lock in profits as trade moves. Also define when you'll scale out of a position. What conditions will trigger a full exit? Never leave exits to chance. Plan before you click buy. Risk management rules: this is the most critical section of your plan. Set in stone: percent of capital risk per trade, e.g., 1%. Max daily loss, e.g., 3% of account. Max trades per day, e.g., 3 trades. Position size formula based on stop loss. Example: I will risk a maximum of 1% of my account per trade. If I lose 3 trades in a row or hit minus $300, I will stop trading for the day. This protects you from spirals and burnout. It also keeps your trading sustainable over months, not just days. Psychology and emotional control section: your plan should include personal reminders: how to handle fear, greed, FOMO, revenge your mindset mantras; break triggers, e.g., stand up after 2 losing trades. Example: if I feel anxious or revengeful after a loss, I will close my platform and walk for 10 minutes. I will not trade again until I've reviewed my last trade calmly. This turns your plan into a self-discipline system. Daily routine: start and end strong. Create your pre-market and post-market rituals. Pre-market checklist: review news, economic calendar, scan for A+ setups, set alerts and key levels, visualize your top setups, breathe, enter focused. Post-market checklist: review all trades, log entries in your trade journal, note what went well and what didn't. Rate your discipline 1-10. These routines anchor your performance. Structure your plan in a simple format. Don't overcomplicate it. Create your plan in a clean, easy to review format: Word doc, Notion, Google Docs, PDF you print out and pin near your desk. Structure: example, markdown, copy, edit 1. My trading style 2. Markets I trade 3. Time frame and schedule 4. Entry criteria 5. Exit strategy 6. Risk management rules 7. Psychology protocols 8. Daily routine 9. Weekly review checklist: it's not just about writing the plan, it's about living it daily. Staying accountable to your plan: even the best plan fails if you don't stick to it. Here's how to make it a habit. Read it every morning before the market opens. Journal trades against the plan. Did you follow it? Rate your execution each day. Review your plan weekly and make small improvements. When your actions match your plan, you become unstoppable. Updating your plan over time: your first plan won't be perfect, and that's okay. Your trading plan should be a living document, growing with your experience. Revisit it monthly. Ask, which parts work well? What needs tweaking? What mistakes keep showing up? Adjust slowly and deliberately. Never rewrite your plan after a bad day. Do it from a calm, data-driven place. Final thoughts. Your plan is your edge in a world full of noise. Your trading plan is your quiet edge. It centers you. It protects you. It elevates you. Great traders don't just chase trades. They execute a rehearsed plan with precision. Starting today, you're not just someone who trades, that you're a disciplined decision maker with a personal roadmap, crafted from intention, not emotion. Stick to the plan. Refine it. Trust it. That's how real traders are made. Chapter 13. Scaling up and going full-time, taking your trading to the next level. Turning passion into profession. Congratulations. If you've made it this far, you're no longer a beginner. You've learned the fundamentals, built your routine, mastered risk, and developed discipline. Now comes the exciting and challenging next step: scaling up your trading and potentially making it your full-time career. This chapter is all about how to grow your trading business smartly, sustainably, and confidently. Going full-time is a huge milestone. It's not just about bigger profits. It's about bigger responsibility, focus, and professionalism. What does scaling up really mean? Scaling up means increasing your trading size, confidence, and income while managing risks carefully. That it's tempting to jump straight into risking big dollars. But successful scaling is methodical. Increase position sizes gradually, maintain strict risk controls, keep your daily routine and trading plan solid, avoid emotional decisions as stakes get higher. Your goal: grow your account steadily and sustainably. Signs you're ready to scale before increasing your trading size or quitting your day job. Ask yourself these key questions. Are you consistently profitable for at least 6 months? Can you handle drawdowns emotionally and financially? Do you have a well-documented trading plan and journal? Do you have sufficient capital to trade larger size without risking too much? Can you stick to your routine even when markets get volatile? Do you have a reliable emergency fund outside trading capital? If you answered yes to most, congratulations, you're ready to think about scaling. Scaling your position size. The gradual approach. Scaling up your position size doesn't mean doubling your risk overnight. The professional approach is a step-by-step increase aligned with your account growth and emotional readiness. How to scale. Increase your risk per trade slowly, from 1% to 1.5%, then 2% max. Increase the number of shares or contracts, not the percentage risk. Initially monitor how bigger positions impact your emotions. Adjust stops and profit targets carefully. Never increase size after a loss or on impulse. Example: if you trade 100 shares risking $100, increase to 150 shares, risking $150 only after consistent success and confidence. Planning your transition to full-time trading. Going full-time means replacing your steady paycheck with income solely from trading. This requires planning. Build an emergency fund covering at least 6 months of living expenses. Ensure you have health insurance and other benefits. Calculate your monthly financial needs. Set a minimum account size needed to support your lifestyle at your current win rate and risk tolerance. Some traders start with part-time trading and gradually reduce their day job hours. Others save a cushion and then take the leap of theirs. No one-size-fits-all path. The key is to avoid rushing into full-time until you're financially and emotionally ready. Managing psychology. When scaling up, larger positions bring larger emotions. Fear, greed, anxiety, and pressure often spike when your account balance and stakes increase. Remember, discipline and mindset must grow with your capital. Tips to manage. Stick rigidly to your trading plan. Keep your risk per trade consistent. Even if your account grows, practice mindfulness and stress management daily. Use your journal to reflect on emotional responses. Consider a mentor or trading coach to help keep perspective. Your mindset is your most valuable asset. Upgrading your trading tools and workspace. As you scale, consider upgrading your setup for efficiency and comfort. faster, multiple monitors for better market view, reliable high-speed internet, advanced charting, and order execution software. Backup systems for power and connectivity, ergonomic chair and desk for long hours. A professional environment supports professional results. Building a trading business mindset. Trading full-time means treating it like a business, not a hobby. That means tracking your trading as income and expenses, keeping detailed records for taxes, setting financial goals and budgets, planning for taxes, retirement, and health benefits, continually educating yourself on markets, tools, and psychology, networking with other traders, and joining trading communities. This business mindset fosters sustainability and growth. Risks and challenges of full-time trading. Full-time trading can be rewarding, but it comes with risks. Income volatility. There will be months with losses, emotional strain. Lack of external structure can cause stress. Isolation. Working solo can be lonely, burnout risk. Long hours and pressure. Prepare strategies to mitigate. Maintain a strict schedule and take breaks. Connect with trader communities for support. Diversify your income streams if possible. Set clear stop loss and max daily loss limits to protect your account. Final tips for successful scaling. Stay patient. Growth takes time. Don't chase losses. Stick to your plan. Keep learning. Markets evolve. So should you. Balance life and trading. Health and relationships matter. Celebrate milestones. Acknowledge progress. No matter how small. Closing thoughts. Scaling up and going full-time is a journey of courage, discipline, and growth. It's not just about bigger trades. It's about becoming a professional trader who can handle success and adversity with equal grace. With the right preparation, mindset, and plan, trading can transform from a hobby into a fulfilling, sustainable career. Conclusion: living the trader's life with discipline and freedom, embracing the journey, balancing the mind, and owning your future. You've reached the final chapter of this journey, but really, it's just the beginning of your life as a trader. By now, you understand that day trading is more than just buying and selling stocks or currencies. It's a way of thinking, living, and growing, both financially and personally. This conclusion is about bringing everything together and celebrating the life you're building, one of discipline, freedom, and purpose. Discipline, the true foundation of trading success. Day trading is often glamorized as a fast path to riches, but those who thrive know the secret. Discipline is the heartbeat of every winning trader. Without discipline, even the best strategies fall apart. Discipline means showing up every day with a plan, sticking to your risk rules, managing emotions, and learning from every trade. Win or lose, it's what keeps your account safe during losing streaks and what compounds your gains during winning runs. As you move forward, carry this truth with you. Discipline is your greatest asset. Protect it fiercely. Growth. Trading is a lifelong journey. Trading is not a set it and forget it activity. Markets evolve, technologies change, and so will your own psychology. To be open to learning constantly. Read books, watch market news, practice new strategies, and refine your plan. Remember, each day you trade, you grow, not only your account, but your resilience, patience, and clarity. Celebrate your progress and treat setbacks as valuable lessons. Growth doesn't happen in a straight line, but with persistence, it's inevitable. Freedom. What trading truly offers. One of the most alluring promises of day trading is freedom. Freedom from the 9 to 5 grind. Freedom to work where and when you want. Freedom to create your own financial destiny. But freedom isn't just about no boss or no schedule. True freedom comes when you've mastered yourself, when your emotions don't control your decisions, when your plan guides your actions, when your daily routine supports your well-being and success. Freedom is the reward for your discipline and hard work, a reward you earn every single day. Balance, the trader's most important skill as you live the trader's life. Remember balance. Balance between work and rest. Balance between ambition and patience. Balance between confidence and humility. Your health, relationships, and peace of mind are just as important as your trading profits. Never sacrifice your well-being for a trade. Trade with respect for yourself first, and the profits will follow. Mindset. Your edge beyond charts and tools. Your mindset is the invisible edge no indicator or setup can give you. A calm, focused mind sees opportunities clearly. A patient mind waits for the perfect setup. A resilient mind recovers quickly from losses. Train your mind daily through meditation, journaling, or simple reflection. Your mind is your most powerful trading tool. Treat it that way. The daily commitment every day is a new chance to follow your plan better, manage your risk smarter, and grow your skills stronger. Trading isn't about perfection. It's about consistency. Stay humble, stay curious, and most importantly, stay committed. Your next chapter you read now equipped with knowledge, strategies, and a mindset to succeed. But the real magic begins when you put it all into practice. Remember, trading is a marathon, not a sprint. Take control of your future with patience, passion, and persistence. Final words of encouragement: believe in yourself, trust your process, honor your discipline, and embrace the freedom that comes from mastering your craft. That you're not just learning to trade, you're building a life designed on your terms. Here's to your journey ahead, full of growth, resilience, and success. Thank you for trusting this guide to be part of your trading story.